Hello, welcome everybody. Thank you all for joining us. This is the first in a series of webinars we plan to run looking at the state of the buy-to-let mortgage market, and it's been a bit of a roller coaster, so I think the timing is quite good. We've got the end of the furlough scheme this month. We've also got the end of mortgage payment holidays, which I'm sure we'll be touching on. We being Property Master, which is the online site for landlords looking for the best mortgage. And I've got with me Angus Stewart, who is our Chief Executive and Founder. Angus will say a few words in a moment. Just a few kind of housekeeping issues. We'll probably be online for between 20 and 30 minutes, but more questions from you, we're always happy to answer them. And if you do have a question, you can see at the bottom of your screen the Ask a Question box. Just open that box and put your question in there. I will be monitoring that and I'll be passing those questions on to Angus, along with some other questions that we've had logged in advance from clients. So let's kick off. Angus, what is happening in the buy-to-let mortgage market at the moment?
Well, as you said, Chris, it's really quite interesting times at the moment. We had the lockdown, and that clearly affected the market, with surveyors not being able to go out there, lots of lenders pulling out of the market, and it's come back with a bang, hasn't it? I mean, we're seeing sort of the highest house prices we've seen or the highest price rate growth we've seen in many years. I think to a large degree that's driven by a relatively small number of large value property transactions that we're seeing in the residential space, as people manage the pent-up demand that we saw during lockdown, and people choosing to move out of cities such as London and move into more commuter belt when they now realise they can work from home, and so that biggest growth is in £1 million plus properties in terms of that sale, and I think that is a mini boom, and sometimes after a mini boom might come a mini bust, and I'm sure we'll talk about that. And this market has also been stimulated by the cut in stamp duty, and although focused again on residential, it does have the benefit for buy-to-let landlords in that you don't get any of the basic stamp duty until the £500,000, so you're purely paying your 3% premium in England. Other countries within the union have slightly different rules, so so you need to be clear where you're purchasing. But if you're going to take advantage of these cuts in stamp duty, you probably need to get your skates on. It takes a while. We're finding transactions are taking longer. Solicitors are working from home still, a lot of them, and therefore conveyancing is taking a bit longer than it did in the past. Lenders are certainly taking longer to process stuff because they've got staff working from home and they're struggling operationally, some of them. And therefore, if you're going to hit the end of March deadline, you probably want to make sure that you're well progressed with your transaction during this last quarter of the year. Don't leave it to the last minute, because there's a real risk that you've missed the deadline. We know some landlords are struggling with tenants. There's been some good news on repossessions in that the courts have now reopened to hear your cases. Downside is that you now need to give 6 months notice of any eviction. And unless you've got a situation of antisocial behaviour or other crimes or other issues, it's going to be a slow process. So that's not ideal for landlords. We're seeing some interesting stuff in the market in terms of what surveyors are saying on valuations. I'll probably talk about that a bit later. I'm concerned about what the impact of the furlough scheme ending is going to be, the impact of further local lockdowns might be. And so although we've got a house price boom at the moment, I think there's a real risk that we're going to see a bit of bust. I think there's a real risk that we're going to see more tenants in trouble as they lose their jobs. And we have seen a seismic shift in this industry, as we have in several other industries which have been affected by the pandemic, and I think we just need to be sensible about how we move forward and recognise the upsides, and there clearly are some upsides for some people, and the downsides for others. So thanks, Chris.
It's about navigating that difficult path at the moment. As you say, there will be winners and there will be losers, both in terms of tenants and landlords. In fact, could I just perhaps have a look at a question here we've had from Kerry in advance about evicting tenants. I can't evict my tenants; they owe money and they're paying nothing. I think, unfortunately, there are a number of landlords in that position. What advice can you give them, Angus?
Um, well, clearly you need to talk to your tenant. I mean, hopefully they're on some form of benefits now. Um, See if you can get a direct credit from the local authority, which might mitigate your position. Kerry, I mean, it's difficult, and I think we're going to find that there are a number of landlords that are in some form of challenge. I think the key advice I give you is, if you can, in any way, continue paying your mortgage. Try not to slip up at all. It will affect your credit rating if you don't make your payments, and that make mortgages and other credit more difficult later. If you are completely stuck, although the payment holidays have now finished, and yeah, I think there were some landlords who have made good use of those. Still talk to your lender. If you've got problems, talk to your lender. But I would hope that there may be some way you can at least get some payment from your tenant in the interim, and seek to do that. It's clear that trying to evict them is going to be a long haul, and therefore anything you can do to generate some revenue now has to be in your benefit.
We've got a little poll here, in actual fact, Angus, that we set up here on mortgage payment holidays. I'm just gonna open that here. You can see two polls on your screen. Have you taken a mortgage payment holiday? Let's just give people a few seconds to answer that. I mean, Angus, how are lenders viewing mortgage payment holidays? Is that something you've been concerned about?
Yes, it's all very interesting in that, right at the beginning of the lockdown period, when these were made available to both residential mortgage holders as also landlords, the view was it doesn't affect your credit rating. Well, the answer is it doesn't affect your credit rating with the agencies if you take a payment holiday, but it does affect your credit availability with certain lenders, who will perceive, if you've taken a payment holiday, that you are under financial pressure, and as a result may well not be willing to give you another loan. I mean, I know people who've taken bounce back loans, and again, some lenders are seeing that as an indication of a challenge. I think my personal view is that for any business that took the bounce back loan, it was the cheapest money that you were ever going to be offered, and therefore it probably wasn't necessarily an issue showing you were under pressure. It's just that you were probably a good, astute business person that can see a good offer when it was made available to you. So if you've had to take a payment holiday, make sure that you start repaying the interest payment now, because those payment holidays have finished. If you can't, talk to your lender again. But in either case, it could easily have some impact on your availability of credit downstream, if in terms of taking out another mortgage, even though it won't be a black mark on your credit reference file.
I think this has come as a surprise to many clients that we've talked to in that position. I mean, just looking at our poll, about 16-17% of people we have online have taken mortgage payment holidays. So that's quite a sizable number. So yeah, take that into account. I guess the advice would be, if you are going to go for finance, go quickly, and talk to us, and we'll work with you. I mean, if you are going for finance now, what's happening on mortgage interest rates at the moment, Angus, in the buy-to-let market?
Yeah, well, there's a degree of volatility here, and I think we have seen an awful lot of change in the market in 6 months. Many lenders pulled out at the beginning of the pandemic, just as lockdown. Most of those have come back in, which is great news. Lenders are using interest rates as a means of controlling volume. Many lenders can't cope with the volumes they're getting, and therefore they either are putting products out there which have got slightly higher rates to limit that, or they're withdrawing products completely for a period. And you'll have seen This week, the Clydesdale pulled all their products. Nottingham pulled them a week or so ago. There's lots of people pulling products for various reasons, and that might be an issue with their ability to cope with volumes. There have also been some suggestions that it's a matter of making sure they're balancing their balance sheet appropriately, because they can't get deposits in at the rate that the lending's going out the door in this rather strange market. So we have seen an increase in rates of margin, which might come as a surprise when base rate has dropped further, but I think you're going to get lenders who are concerned about risk. They can see that there's increased pressure on payments in the market. We've got 16-17% of our people on here have taken mortgage payment holidays. Lenders will be taking that into consideration, saying, well, potentially we've got a slightly higher risk scenario here, and therefore they're pricing in risk into their prices. So we have got slightly higher margins. Are they rising? I think they probably, we need to keep that under control and keep them under. But if anything, I think we're going to see some slight rises in margin over the next few months, as some of the challenges of the economic position flow through. I think lenders are going to be more prudent in terms of how they position their products, and we may, sort of low, very low interest rates we were seeing a year or so ago, I think are gone for the moment.
What about there's been quite a bit of discussion in the media about negative interest rates. I don't know whether or not that could happen, but if the Bank of England were to go for negative interest rates, can we expect buy-to-let mortgage rates to fall, or are these other aspects more important?
I think it's unlikely we'd see any significant change in the rates that banks are providing to us. Negative interest rates is a situation where the banks effectively are being charged for holding funds, and so I think we'd continue to see a drop in deposit interest rates that customers receive, which again may discourage people from saving, and therefore might stimulate economy where they are spending more. So we may see some change there. But we've seen negative interest rates in Europe for a while. We've seen them in Japan in the past, and I don't think you're going to see a significant impact on mortgage rates as a result of us moving from a 0.1% base to a minus 0.1% base.
Okay. What about LTVs? What's the movement there? Looks as if landlords have to find ever bigger deposits. Is that still the case?
Sort of yes and no. Certainly, as soon as we had lockdown, many lenders dropped to a maximum 60% LTV. We've seen that slowly increase. 75%, I think, is the norm. We've seen some buy-to-let products up at the 85% level. Not many, but 80-85 has been out there. I think the challenge with that is one of affordability, and would you get through the affordability tests on an 85% mortgage? And in many cases, you wouldn't. And even those are now getting pulled a bit. So I think 75% is probably where it's all going to settle out for most landlords. And if you can't get to a 25% deposit, you're probably going to struggle to place, even if there are mortgages allegedly out there with a better LTV for you. I think trying to get them could easily be a challenge.
Paul has just posted a comment. He quite likes the idea of negative interest rates, but I'm sure, Paul, you're not expecting to get that on your next mortgage. Incidentally, anyone who wants to ask a question or post a comment, just open that ask a question box, and I'll keep monitoring that. Just to move on, Angus, what about HMOs? Because last time we were with clients, HMO mortgages were more difficult to get. Has the market returned to those more complex propositions?
Yeah, you can get HMO mortgages. There are people out there offering HMOs. It's still not an easy place, and again, it depends on you as a landlord. If you're a first-time landlord, never owned a property, an HMO is not the place to start. You'll find that many lenders out there don't like first-time landlords, and they certainly wouldn't like first-time HMO landlords. So they're looking for people with a degree of experience. You are likely to pay a slightly higher interest rate on an HMO, but then again, you should get a better return, given you've got multiple people in that property. I think the other benefit of an HMO at the moment in this uncertain market is that you would have a number of people paying rent, and if one party lost their job and you know, was letting you down, maybe you've got spreading the risk of it within that HMO. That said, I think you've got to be very careful where you purchase. If you think of the sort of people who tend to inhabit HMOs, they tend to be people in the hospitality sector, or they might be students. Both sectors have been badly hit by the coronavirus and by the jobs or education, and so like everything, it's location, location, location. Understand carefully who you're going to put into those HMOs and try and mitigate your risk if you think you've got too many people of a particular employment type or particular area of risk and concern from an employment perspective. And I think screening tenants is going to be your most important thing going forward, because none of us can afford to have tenants who can't pay.
Absolutely. Charles has just asked Angus about limited companies. What's the buy-to-let mortgage market looking like for those?
Charles, pretty good. Many more lenders keep coming on to the market offering limited company buy-to-lets. I can see that for some people, if you are looking to buy, a limited company might be the best vehicle to put it through. With stamp duty reduced at the moment, you might want to get some advice whether it's right to move your properties from your personal name into a limited company, given that you've got a sale and purchase. But with lower stamp duty for a short while, maybe it's the better time to do that. I'm not a tax advisor. I'm certainly not going to give you any tax advice, but I would go and talk to somebody if that's your personal position and see whether there's a good timing here. But no, limited company, we see a significant volume of business in limited companies, and it's certainly, for many people, it's the way to go.
Anthony has just commented on that as well, saying he's seen some lenders come into that market that he's never heard of before. So who might they be, Angus? What are the lenders who tend to look at limited company lending?
Yeah, well, probably about half. We've got details on about 100 lenders on our system, and best part of half of them will now do limited company. And you're right, some of them are maybe names you've not heard of, and to a large degree that's because some of the larger lenders in the market, their systems can't cope with processing limited company. They may dearly like to get in there, but they're in a large organisation, they haven't got the flexibility. So just because it's a name you've not heard of does not mean that they're not a particularly good lender. By all means, talk to us. We're very happy to give you our opinion on that particular lender in terms of their processing and experience that we've had with that lender with other clients, if you've got any concerns. But there are some new players in there. Don't be too concerned if you've not heard of the name. It's a moving market here, and new players are coming in all the time.
Just had a question from Tim about interest from non-UK buyers coming into the UK market. Is that something we should be taking note of?
I think some of the growth we're seeing in the residential market at the moment is non-UK buyers coming in onto the residential, purchasing with cash rather than with mortgage. I think a non-UK buyer, they haven't got the right to live in the UK. They would not get a mortgage in the UK. We have seen that for expats, British expats working overseas, the market went a bit tight during lockdown and lots of people pulled out of the expat market. Again, I'm pleased to say some of that's coming back in, but it's still not back to where it was previously. So I think, again, depending on somebody's circumstances, it does differ. But is there foreign money coming in? Yeah, I think there is some foreign money coming in.
A question from Ashley, a specific question here about having £5,000 outstanding on a mortgage. Is it worth clearing that?
I think it depends how much you're paying, Ashley, and whether it's the right time to, have you got better use for that cash? The answer is it might be worth clearing it, but if it's not causing you any pain, maybe it's better just to let it tick over as long as you're continuing to make the appropriate payments.
It's looking like actually he's thinking about remortgaging. So does that have an impact on what is the best course of action?
Um, I think it, if you're looking at remortgaging, you need to understand whether there are any penalties on that £5,000. I would guess they probably wouldn't be that large, you know, depending on the term or whatever. So, and it depends on timing. I mean, what I suggest you do actually is have a look at our system, put in your details. We're happy to have a chat with you and say, well, what's the best way of either doing a remortgage or raising the funds without it impacting you adversely. But it wouldn't surprise me if repaying that 5,000 and then being in a free position to do something might be a good strategy in that case. It does depend what you're trying to do.
Okay, so question here from Ian on HMOs, which we touched on a little while ago. I'll read it to you, Angus. When you convert a house to an HMO, have you increased the value of the property in the lender's eyes? If so, will the mortgage lender recognise this valuation or only value it as a standard family home? Ian's planning to spend around about £100,000 to convert, so obviously he'd like to get that back when he remortgaged. How do lenders view that sort of a property?
It all comes back to the survey and valuation, and the lenders don't tend to do the surveys themselves. They will employ a third party to do a survey and give the appropriate valuation. Therefore, if you're in an area where there are existing HMOs where you can actually have some proof of what the value is in terms of revenue on that property, then the surveyor should take that into consideration in terms of any value. I think what you're likely to see is that I wouldn't have thought you'd see a significant increase in value of the property per se. You may not get £100,000 back in that, but what you should get is an increased revenue identified as a fact there's now an HMO, and as a result, that should ease in terms of getting a mortgage. So it comes back to what's the value now. If it's let's take an example. If it was in good condition now, spending 100,000, I can't see it increasing by 100,000. If it's sort of in a poor state now and would needed money spending on it to be a decent residential property, then you're much more likely to see that increase in value as part of that work. So I think it's going to be an individual situation. Again, just make sure it's in an area where HMOs are found and useful. I mean, if you try and put an HMO into a sort of a very highly desirable residential area, you're probably not going to get the same return as if it's in a location where there are people who where HMO properties are in demand. But again, it could be a sensible thing to do. What I would say while we talk about values and surveyors and so on, we're seeing more, more and more valuations coming back at lower than we'd expect. And so despite all this wonderful increase in the noise we're seeing in the market about house prices going up and isn't it great, the reality is that surveyors are already marking price values down and rents down, and they're seeing that you might think you can get £1,000 a month on this, but they may come back and say it's £800 a month. And even if you've got proof that you can get £1,000 a month, and that's proving challenging for some of our customers at the moment. We've challenged some of those with the lenders, and the valuers who need to be able to justify any price that they give to that lender. Some of them are erring on the side of caution in this rather uncertain market at the moment, and that's can cause people some grief. So
that's interesting. So there can be a lot of froth about house prices, but if the valuers are marking your property down, that it really is just froth, then, isn't it?
I think there's more froth out there in terms of what the press are saying, and the reality is that people are looking forward over the next 6-12 months, looking at some of the economic data, listening to what's happening with furlough and lockdowns and so on, and they are saying we're not sure. It's better from their perspective to mark property values down to a degree and mark rentals down or potential rentals down to a degree, and err on the side of caution rather than have lenders later come to them and say, you said this thing was worth £1 million, it's only worth 750, and find themselves in a pickle. So I think we are seeing the beginnings of a self-fulfilling prophecy to a degree on prices and values coming down slightly.
Got a question from Raoul here about rent guarantee insurance, Angus. I don't know whether you have any views on that. I mean, obviously Raoul's looking at it, wondering whether it would be worth it. Any feedback from clients or anyone else that you've seen?
Yeah, I wouldn't position myself as an expert on rent guarantee insurance. What I do know is that many of the insurance companies pulled their products at the beginning of the pandemic, and you may struggle to get rent guarantee insurance at a sensible price in this market. Certainly, if it's going to cover situations where somebody, where coronavirus has caused challenges, I think it's a bit like travel insurance. They're looking for reasons to get out of it rather than cover. But so I don't want to position myself as an expert on rent guarantee insurance. By all means, talk to people about what's available out there, but you may not find it covers you. Just check the policy, and it's going to cover you for what you need.
Question from Kerry here about upper age limits, as it were, on buy-to-lets. Kerry's 82. Is it still possible to remortgage a buy-to-let?
You're starting to get at the top end, Kerry. Have a look at our system, and we do include upper age within the criteria, so we can actually show you which lenders would lend to you at your age. You might want to consider moving it into a limited company, which for many organisations doesn't have any age limits on it, especially if you can have another fellow director or shareholder on there who's younger. So there are ways to mitigate some of the challenges. There are one or two lenders out there who have no upper age limit, which is good news, but they're few and far between. 82 is getting at the point where many lenders are not going to want to work with you, unfortunately.
Okay. There's a question, I'm not sure of the name, I think it's Toyin. This is an interesting one. I'm hesitating whether or not to invest at the moment. So I'm not sure of what the buy-to-let market will look like in 2021. So I'm going to throw that over to you, Angus, to have a little think. But let's just do another poll here. So we've got a poll. Oh, people have already started on this one. Are you planning to add to your property portfolio? So if you open that poll and just let us know your views on that. But Angus, it's a bit of a difficult one. Do you want to get your crystal ball out? Is it worth it? What's going to happen next year?
Well, God, if I wish I knew. I mean, I think there are lots of people who wish they knew what was going to happen. And we can be positive and say, well, yeah, they will find a vaccine to this virus, and at some point during 2021, things will start returning to normal. Alternatively, they could find that the vaccine doesn't work the way they want it, and we're going through a series of lockdowns for the next 2 years. I don't know. I mean, what I do know is that I think we're going to see some volatility. I do expect to see some people unable to pay their mortgages, both in sort of the residential space and potentially in the buy-to-let space. I think there will be some very good buys for people over the next 12 months or so, 6 to 12 months. I think if I was a portfolio landlord and I had equity available within I think what I would do is remortgage one or more of my properties to give myself a little war chest, and be in a position to pick stuff up at auction or be able to move quickly on things if I saw the right opportunity at the right price. So I think, will there be investment opportunities there? Yes, there will. I think they favour people who've got a portfolio already because they can mitigate risk on one or two tenants not paying. I think I would position myself to take advantage of situations as they arise, because none of us really know. But I do think there's going to be lots of people losing their jobs. I think there's going to be stuff out in the market. There's going to be distressed sellers, and there's an opportunity for people to pick stuff up. And I think, if you're going to do that, then be prepared. Remo a couple of things, have a little war chest, be there ready to pounce when you see that opportunity turn up at auction.
Excellent. Toyin was also asking, how can one introduce a young adult into buy-to-let investment? She has some savings, but she's currently living at home. So this would be a first-time buy-to-let buyer, wouldn't it? So what's the situation there?
Well, you've actually got, from my understanding of the law, she's actually in quite a nice position. If she's never owned property before, she can buy a property without any of the initial stamp duty. So, she pays the 3%, but doesn't pay any of the other stuff. Now, the benefit isn't really that great until March, but after March, when we go back to the normal stamp duty thresholds, she could be in a better position and actually have a cheaper purchase as a result of that. So, worth looking at that if you're buying buy to let, but you've never been a property owner, you're a first time buyer. There are some benefits. I think if you're in a situation where you can gift a deposit or something to this individual so that they've got 25%, it could be quite a nice way of starting them on their journey of life. Clearly they can't live in it, but they could get a revenue from it which might be able to pay for their living elsewhere. I think if I was in a position and my kids were a bit older, I might look at see what I could do to help somebody on their journey with that.
Oh, that's really good. Well, Toyin, if we can be of any help, have a look on the site. But that sounds really positive, which is great. What about rents, Angus? What's the outlook on rents at the moment? What do you think's happening there?
I think mixed is the honest answer, Chris. I think if you look at central London, where traditionally we've had lots and lots of demand for property, rental property. I think from a tenant's perspective, I think we're going to see that drop to a degree. I think why is somebody going to pay a premium to live in zone 1 or zone 2 if they only need to go into their office once or twice a week? They might be happier to have a slightly larger property that they're renting, I don't know, zone 6 or something like that, and just commute in a bit further when they do need to be in the office. So I think we're going to see a bit of a shifting in some of the rental elements. Again, we're going to, but I do think on the whole the demand for property will increase. So I think we might just see some levelling of stuff rather than a total lack of demand. I think even people who are currently owning properties, if they're in financial distress, they're still going to need to move and live somewhere. So overall demand for rental properties, I think, will maintain itself. I think we may see some movement on rents in different ways. And and I think the key thing here is if you've got a good tenant in there and they're under a bit of financial pressure, you're better off trying to do a deal and keep that good tenant rather than hold out for £100 more a month and not have somebody in there. Good tenants are hard to find, they're worth keeping, and the important thing for any landlord is continuous cash flow and being able to manage their portfolio effectively.
Just Ian's picked up on this age issue as well. What about the age of directors? If it's a buy-to-let limited company, does the age of the director count at all in the credit process?
It sort of depends on the lender, but as long as they're 18, I think you should be okay. So they need to be of legal age to execute documents. I know you can technically be a director of a company below 18, but I think if you're taking a charge over it, they'll expect them to be 18. But yes, with most organisations, some might say 21 or 25, but I think you should be okay. If some of the directors are younger.
Anthony,
sorry, Chris, and that can be a good way of over time moving the value from one party to another. If you're moving shareholding between family members, for example, as part of you can set up a structure to enable you to do that in a tax effective way. Get some tax advice on how you do it. I am not a tax advisor, but I would look at that as being quite a sensible way for families to do stuff.
Yes, I think there's been a lot of talk of buy-to-let landlords moving their properties in to a corporate structure, sometimes in response to the stamp duty issue. Have we seen that at all?
Well, as I mentioned earlier, I think with stamp duty where it is at the moment, if you were going to move properties from one structure to another, then it's worth considering. You've also got to think that you've got a capital gains tax issue there as part of that movement. So again, get some specific tax advice on what it is you're looking to do, and it needs to be tailored to your personal circumstances as to what's right and how best you do that. And again, if you've got a family, you might want to include how do you actually move in a tax efficient way, assets from one family member to another.
Mm-hmm. Because Ian was also asking about the cost of setting up a limited company, but Ian, if I remember having done it, it's all publicly available information. I can't remember the exact fee. Angus, I'm not sure whether you would know that. Or...
Yeah, you can set up the limited company for £100 or £200. Again, talk to your accountant; they can do that for you. The setting it up isn't the issue. The issue is making sure that you understand how to manage that in a tax efficient way, which meets your own personal needs. And you need a tax advisor or an accountant to work with you in terms of how you're going to do that.
Just coming back on LTVs as well, Anthony is saying, I just trouble you again on LTVs. Lenders I have spoken with have reduced their LTV by 5%. So is 60 to 65% the going rate?
Again, it depends on the lender, Anthony, but certainly you can get 75%. You can still get more than 75% from a handful of lenders, but 75 seems to be the norm. 60 to 65. I think if you're in London, for example, and you've got a property which is high value but relatively low yield, you may struggle to get more than 60 to 65% because of the affordability rules counting against you. You may be in a position where you can use top slicing of income to get above that. But what I'd suggest is you go on our site, put your details in there, and it will show what is or isn't available. And then if you talk to one of our advisors, they can explain. We've actually got some technology that sits behind here that's for any given lender. I can show you how far off you are on the affordability for that particular loan with that particular lender. And that might actually be quite useful to you to actually understand where some of the dynamics are here. Because sometimes it's a matter of, if you got £10 a month extra rent, you could actually get yourself into a different LTV band. It could be as simple as that. So it's a conversation doesn't hurt in these situations.
Excellent. And what about holiday lets? Sort of wrapping up now in terms of time, although I'll keep monitoring the questions. Fantastic questions coming in, but there's been a lot of comments in the media about holiday lets being a way to go, as well as limited companies in terms of the type of assets. What's your view on holiday lets, and in particular how the lenders view them?
Well, some lenders like them and some don't, as with everything, but my personal view, I think it's an interesting time to look at holiday lets. I think 2021 is going to be another year where we have lots of Brits holidaying in the UK. They may not want to travel. They may not be able to travel with some of the quarantine type rules that we're seeing at the moment. And I can't see that disappearing in the short term. Therefore, UK holiday let property could be quite attractive. And there are some other tax advantages to you if you're doing stuff in holiday lets as opposed to buy to let. And as long as you don't use it for more than a certain number of days a year, you can actually use your holiday let yourself. It's just got to be on the market and available to other parties. So have a look at holiday lets. There are lenders out there who let you do holiday lets. There are lenders out there that let you use Airbnb. They recognise now that Airbnb is actually quite a good way of doing holiday lets, at least some of them do. So the opportunity is there, and you might find that it's actually more attractive in some ways. The one thing I would say is holiday lets sometimes are more difficult to get the initial mortgage, but if you already have a buy-to-let property in a particular location, maybe if your tenant leaves, look at whether that should be a holiday let and see whether you can do something with that, because again there's some tax benefits to it. But it's worth looking at. It's not as easy to get a holiday let mortgage as it is to get a buy-to-let mortgage, but there are definitely lenders out there considering it.
Fantastic. Just checking on our poll here about, are you planning to add to your property portfolio? 86% of you are planning to do just that, which is really interesting. And Rob has asked us to say a little bit more about Property Master. Well, given we have so many people on the line thinking about expanding their portfolio, Angus, why should they contact us?
we've developed a system which is different to anything else in the market. Well, the way Property Master works, it will take information about you, the property you're looking to purchase, and the portfolio of properties you've got, and then match that against the lending criteria for 100 lenders. And then after that, it will say, of the 100 lenders who like the look of you and your property and what you're trying to do, where do you sit in terms of affordability? Because we now have all the affordability rules, both at a product level or a single purchase level, property level, but also across your portfolio. And there are certain rules that you need to pass across the portfolio. And once you've done that, we will then prioritize all the lenders who are willing to consider you in order of what's the best deal for you. And so we've put a lot of effort into the technology. If I say so myself, it's quite a slick and clever system in the way it works. It will find opportunities for you that no other broker can find, because the rules are so complex that most brokers cannot remember the rules for 100 different lenders out there. It's impossible for you to do that, and the data isn't available elsewhere. We've put a lot of effort into gathering and collecting that data and putting it in a format that we can use from a artificial intelligence perspective. So that's why you should look at Property Master, because it will uncover deals that you cannot get elsewhere. We've got a great team of advisors who can work with you, happy to pick up the phone and chat with you and talk you through to find you that best deal. And we have a lot of very happy customers. And it's great to see that people are looking to expand their portfolios. We specialize in portfolio landlords. The vast majority of the people we've got on our books are portfolio landlords, because once we've done something for somebody, all the data's in the system, all your bank statements and everything else that lenders require are in our system. And so it's very easy to do your second and subsequent mortgage with us. We make life easy for landlords, and that's why they like us.
Thank you, Angus, and thank you all very much, all those of you who joined us today, and those who are listening to the recording. There will be a recording of today's webinar, and we'll send that out as soon as we can. We'd love to hear from you as well. What did you think? I think we picked up pretty much everyone's questions, but if you have others, you can get us on info@property-master.com, and we'd love to hear from you. We do plan to do more of these, so as I say, do let us know what you think and what you would like us to cover. Thank you all very much. Goodbye.
Thank you. Bye-bye.